Hey everyone, here Joe Delia with the Delia Group here at Keller Williams. I want to touch base with you as we kind of wrap up the year of 2020 going into the last month. And I think just some perspective on the market is critically important. We've had a lot of things happen this year. It's been a crazy year in real estate. The leading one is interest rates have increased by over 4%. So in January, we were down in the threes. We got up into the mid sevens, but it's been an interesting year, right? So when rates more than double and they're the fastest increase in the history of our country, you know, that kind of throws shockwaves through the market, which is what we've seen. Right now, an interest rate around, and we're at the end of November going into December here, interest rate's about 6.5% as a general average, right? And that's on a 30-year loan. That's dropped over 1% off the top, like I just talked about. So rates are actually on the decline, despite what you hear a lot in, you know, the sensationalized media. In 1981, which is actually before I was born, rates peaked out at 16.82%. We've got a long way between where we're at and that, right? A couple things to think about is like the historic average for interest rates is around 6%. So it's actually a little bit over. So we're right there in terms of historical averages for interest rates. And what we've seen in the last couple of years is an extremely low, artificially suppressed via the Fed interest rate. And so what that did is it spurred demand, drove inflation, drove appreciation, drove demand. We front loaded a lot of that. And then to overcorrect it, they went in, you know, more than doubled the rate in just a handful of months. So neither of those things were smart things to do. They didn't need to overcorrect it and they didn't need to overstimulate it. So that's kind of where we're at. In extreme sellers market, I mean, we were looking at stuff 30, 40, 100,000 over. You know, I've checked out my other videos on that. And so essentially what was happening is the buyers were coming in the last couple of years and they were automatically going in underwater because they were overpaying on appraised price by 20, 30, 40, $100,000. And today that's not true. Today, the premium properties might get into one of those blind auction atmospheres, but everything's, you know, back to what I would call balanced market. Even though inventory levels aren't quite at a balanced market rate, a balanced market's about 6 months worth of inventory and we're a little over 2 months. So we still have a long way to go but it feels like a balanced market where both the buyer and seller have equal negotiating positions. Whereas historically, you know, it's been really seller the last really 3 years, especially the last 2. Whereas now, you know, both parties are kind of on equal footing, which is actually good for both groups, because if you go to sell, you still can get one of the top prices in the history of ever for your property. And then when you go to buy, you don't have to go and start underwater and speculate that the price is going to catch up. We've already seen rates come down by 1%. So the idea that they might drop again going into next year, I think is very likely, allowing you to be able to refinance. And there's also some additional programs where you can get a reduction in interest rate up front. One of the other challenges we're going to have going into next year, which is actually reality based and not sensationalized like on the media, is we're anticipating about 4 million and maybe up to 4.3 million in total closed transactions on a national basis. So what does that mean? Well, that means it's the top 3 lowest units closed since we started tracking it, since the whatever years, 70s. We're gonna have a top 3 lowest units closed, and that's because you're not gonna see the amount of people come on the market, right? What happened? Everybody refinanced into a 2 and 3% interest rate. So if they go to sell and go to downsize, at today's rates, they basically be paying roughly the same payment. So what that's gonna do is keep inventory low. And one of the ways that prices decrease is inventory increases. Well, as a result of not a lot of inventory coming on the market, that's not going to create this massive 6, 7, 8, 9, 10, 11, 12 months worth of inventory that then sellers are competing on a downward spiral with each other. What it will do is force all the sellers to be realistic instead of, you know, dreaming pricing. But that realistic is still a price that they wouldn't have gotten 2 years ago. So they're essentially selling equity that was artificially stimulated by the Fed and money they never really put into the house. So the ability for them to negotiate will be there because they have equity, and the buyers will have interest rate affecting their price. So affordability is still kind of low. But if rates were to come back into the 5s, I think we'd see all the pent up demand, because the demand hasn't gone anywhere. The demand's just been delayed as a result of rates. So if they can get the interest rates back into the 5s, you're going to start to see that days on market creep back down and potentially put us back into a seller's market, because there's not going to be enough inventory coming on the market in order to put us into a buyer's market, if that makes sense. So all of those things I think are worth considering. Prior to this, we've been seeing over 20% interest rates in the last 2 years, over 40% appreciation on a national basis in 2 years. Those aren't rates that are going to be historical. Remember, the 4% trend line means on an average we appreciate 4% a year. So we really should only been up 8% roughly, right? 8% roughly, a hair more because it would be 4% and then 4% in addition, right? But 8% versus where we were in 2020, right? So instead we were up 40%. So what I think is going to happen is we're going to level off, maybe a slight deflation in places where it inflated a little bit too much. But overall, you're not going to see a crash in pricing. And everybody who goes to buy in the next 12 months is going to be in a really good spot. It's going to be a great purchase for them when they look back 5 years from now, because they're going to have the ability to refinance when rates dip back into the fives. And they'll be sitting at historically a very good interest rate, and they'll get a property for a fair price. And then they're going to watch the magic of appreciation happen over time. Buying or selling, whether it's an investment property or personal residence, is a huge undertaking. Usually a property is their biggest investment of their life. So make sure you're working with a qualified agent that's up to date, understands what's happening, knows the different mortgage programs that are taking place, because the difference between a great realtor and an average realtor, when everyone roughly charges the same, is massive. And you don't really know that until after the transaction, or you never really would have found out that you could have gotten better because you don't know what better looks like. So I encourage you to reach out to one of the top performing teams, which is us, and at least interview, right? There's nothing wrong with a second opinion on what you should do and where you should go. Thanks for taking the time to talk some economics with me. I really appreciate it. If you have any questions, go ahead and reach out. You can send me an email at joe@thedeliagroup.com. My cell phone's 248-933-9462. If you like this video, hop on our YouTube channel, like and subscribe. We've got tons of educational content that will be coming out all the time. Thanks, appreciate you.